Good afternoon, everybody. It is 1:03 p.m. Sorry, a couple minutes late there. It is the 29th of October on this Monday. Man, it's crazy. It's going to be November, isn't it? Like, it's just crazy. I really can't wrap my head around that yet, but it is what it is. Yeah, we just have to suffer through these fast years that seem to be going faster and faster. Although, if you look at our crypto markets, it doesn't feel like they've been moving pretty fast, but we did finally see some activity after about, I don't know, 14 days of 2 weeks straight almost of just kind of meh going on. And really, we have just decided to continue that meh going on. We have not really deviated much at all. It's weird when a move like today is considered a big move relative to the past 2 weeks, but otherwise it's meh, not much going on. There's Cardano right there, Ethereum Classic. I mean, we're creating this day where we're getting a lot of volume coming in and forming these structural double bottoms on the short-term time frames. Like Litecoin is getting a lot of move. This is a fun chart to look at, though. If we want to talk about market geometry, prices just kind of drifted, and then right as it came up against this Gann arc, just fell right down. It's always fun to watch. And then Ethereum, what are we looking at? Same thing. Really not a lot to talk about as far as the trading range, because that trading range has really not been any different. We saw we were back here on the 14th. So 2 weeks ago, we were trading around 192.52. We're at 195-ish, 194-ish. Not a lot of change in the direction. We have had, on this triangle, we are below it right now. And there's been testing up on the hourly. So the thing is that if this is a failed test higher, then it's really not showing any urge to continue the pressure selling. This could just be a pretty interesting little bear trap. There's always a little pump before the dump, and that is a very, very common thing to see out of a consolidation. Is you get a failed drive lower and then it gets picked up. Sometimes we need to get that momentum to the downside to get people in. And then looking at Bitcoin as kind of the overall barometer, not a lot of change. I mean, this is it. Like, we moved $100 or so. That's it. Still above the trend line, so not seeing any major difference. And because we're in such a flat market still, we're going to go over something today in market education. Last Friday, we talked about trend lines. So doing some new trader information and new trader things to discuss. And the first thing we talked about, again, was trend lines, how to form them, how to use them, how to trade with them. And then probably one of the next things that people learn about when they're new to trading is moving averages. And so we're going to go with that today. I'm going to look at the hourly chart here. Now, moving averages, I'm sure a lot of you know what they are, but they are just let's see. I want the liqueur. Where are you at? Want the Laguerre moving? We did the hull. What am I missing here? Weighted exponential. There's triple EMA. Whatever. We'll just do these for now. So the basic moving average is just it's just taking the close of a certain number of periods back, and then it plots it. All right, it averages them. So, you know, if the close was So the default on TradingView, I believe, is a 9-period moving average. Yeah. So a 9-period moving average, when you see it plotted out on your screen here, that's this line. All that is it takes the past 9 periods, the close, and then it takes that divided by 9, and then that is the number that's where the line goes. A EMA is an exponential moving average. And so moving averages, they can feel a little lagging. Well, and really all lagging all moving averages are lagging, but the EMA is probably something that is a more efficient moving average, versus the regular moving average. There's really, you would want to use the EMA, and the EMA, there's a, you can get the calculation for the EMA, the formula for it, but the EMA is a much smoother kind of average. It's a let's say, so it's really just, you know what, let me just put them next to each other. How's that? I'm going to color the EMA here blue, dark blue, and then the regular moving average, I'll color it red. So they're both 9-period moving averages, and you can see that the regular moving average, the red one, looks a little like it doesn't seem to catch a lot of things, whereas the EMA seems to be more sensitive. And really, we're calculating the average price over a number of periods. So we get the daily close, and we divide it by that number, multiply it. Excuse me. It's close minus the EMA times the multiplier plus the EMA of the previous. So it makes it a little smoother. Okay, it's the purpose of the EMA is an attempt to filter out a lot of the whipsaws that may happen, although it still doesn't respond like that. So the EMA. Then we have a weighted moving average. You can see that one there. And then the Hull moving average, which is a very, very sensitive moving average. Hull moving averages. Folks, there are a ton of moving averages out there. There's all sorts. And I mean, people try to find one that works better than the other. And I think one of the biggest things that people sell to people is the moving average crossover system, which is, I mean, TradingView has one of these. So the Arnaud Legault, there it is. But if we want to go to strategy, moving average, MA cross, where are you at? Moving average crossover strategy. Well, they have a default one. Where the hell is it at? I think I got to go to Pine Editor. New moving average cross. Okay. Add to chart. Damn you. I got to go to 4 hours. And if I go to the strategy tester, there it is. Okay, so here we go. This is the strategy tester. This is the moving average crossover system. And all it is doing and where's our text notes? I don't want text notes. I want Pine Editor. What is it? Yep. So it's just when price crosses above a 9-period moving average, you buy, and when it crosses below it, you sell. And then there's a 1-bar confirmation, okay? Lots of trades all over the place here, but according to the strategy tester, this is actually a performance summary. It's pretty good, right? Net profit $19,846. The average winning trade is $150. The average loss is only $50. Looks great, right? Backtesting is, if you are not yet profitable as a trader, backtesting is a surefire way for you to end up losing more money. Because the thing with backtesting and with anything is that it really depends on how the backtesting is done. Does it do like a walk forward calculation, basically where it starts at a particular date and then it actually moves forward, assuming that it doesn't it's not going to take into account stuff that has already happened. Okay, so it tries to emulate as live as possible. Okay, and what a lot of people do who are new to trading is they will take whatever system they've done or created, and they'll adjust the parameters on it until they have the best performing backtest that they can find. Okay, they will create conditions that make a favorable backtest, and then once they go into the trading of it, it doesn't work. And moving average crossover systems are a great example of things that don't work. Okay? Because often what we see in any moving average system is we're going to get two EMAs here. We'll do the 21 period. So that's our slow. And then we'll do the fast period at we'll leave it at 9. Okay. And so the theory is, how you trade this is that whenever you see the green line cross above the red, you take a long trade. And whenever you see the green line fall below, you take a short trade. And holy cow, does it not look like that is a winnable system? I mean, really, why wouldn't it? Okay? I mean, even if we want to do the market replay, just watch this play out, and really we'd already be long, so we don't really entertain taking a short trade until the fast moving average has crossed below and closed below the slower moving average. So the green, once the green crosses below the red, we sell or we short. Okay. Seems like no big deal, right? I'm going to tell you something about moving average systems. You've probably tried them and found them not to work. You've probably tried them and see that they work sometimes. But when the professionals look at moving average systems, and when they write in the professional curriculum that they're not a good idea, probably a good idea to avoid them. All right? For short-term time frames, they're just not something that you should use. And when I mean short-term, I mean anything shorter than a weekly chart. Now there are things that are important with moving averages. Not saying that they're all bad, but the 200-day moving average is a pretty good. 200-day moving average is a pretty good barometer of what a market is doing as far as does it look bearish or bullish or bearish. Now we can look at the Ichimoku system and get a better idea of what is what is bullish or bearish because of where the cloud is at. But the 200 period moving average is a pretty popular. This is what's used on Wall Street to determine if something is bullish or bearish. Okay, that's what Wall Street uses, the 200-day moving. It's like one of the only indicators that they use as far as classical traditional investors. The 200-day moving average is like the bread and butter of determining where something is at. Is this a bearish or bullish market? So it's a 200-day moving average. And the reason that they use 200 days is because the market isn't open every single day. There's about, what is it, like 200 some, how many? $252 trading days in a year. And actually I've seen 250 moving average. But I mean for cryptos, this is one where you might want to consider doing a 300 period moving average or a 350. So a 350 period moving average, that would be the equivalent of like equity markets and futures markets using a 200 period moving average. Okay? Because we have 365 trading days a year. So there it is. Otherwise, you can keep it at 200, and if you traded only Bitcoin, if you only traded Bitcoin futures markets, you would not worry about the weekend at all. You'd just have gaps that show up and fill. So the 200 period moving average, that is the kind of the broad, on a daily chart, that is the broad indicator of where something is at in its trend. Now, that is with candlesticks. Moving averages with Heikin-Ashi, also very dangerous to try and trade. Actually, Heikin-Ashi is an interesting style of charting, and I think it's very deceptive. And I think a lot of new traders look at it and think, well, this is a way that I can trade this market. Heikin-Ashi all Heikin-Ashi is a trend indicator. Okay, it is only a indication of what a trend is doing. Okay, that is all it's supposed to be used for. You should not trade off of the Heikin-Ashi charts. Definitely should not. Because while they do look the same, while they do look like they give you good signals, they don't. If we go side by side here, okay, we've got let me go to the daily. So here's the daily chart of Bitcoin. And here's the daily Heikin-Ashi. The thing with Heikin-Ashi charts is that they always open at the middle of the prior Heikin-Ashi candle. Okay? That's why you see the opens, that's why you see it like stair step down like this, because the open of every candle is going to be in the middle of the trading range that the previous Heikin-Ashi candle was. Okay? But Heikin-Ashi should only be used as a quick look to see what is a trend doing. Okay? And there's a whole bunch of different strategies, actually, long-term strategies based on, when they when you start seeing wicks on the top and a down move, that's an indication that, you're going to probably want to be entertaining a long trade at some point. But there it is. Because this right here, this candle right here, does not look like the one over here. Okay, this price action here does not look like the price action here. And there are people who've used things like NinjaTrader or MT4 to use trading systems where they've used the calculations of the Heikin-Ashi candles as their entry and exit points, and oh my gosh, that's just going to ruin your trading account. Okay, off of Heikin-Ashis. Now, where is something that moving averages and crossovers are probably okay to do, and that is with price only charts. And so that is where I'm talking about things like Renko charts. And traditional box size 200. You know what, just for having some activity to look at, we'll use 100 periods. Okay, so again, Renko charts, folks. Each brick represents a period of time, or not a period of time, sorry, a price. So each brick is worth $100. So every time Bitcoin moves up $100, it's going to paint a green brick. And then if it moves down $100, it's going to paint a red brick. Moving averages in a Renko system are actually all right. And I've actually had success with them. And I don't do this often, but I frequently reference right at the beginning of my trade day in the morning, like at 5 a.m. I always look at my Renko charts or my point and figure charts, and I have moving averages on them. And that's actually up on my laptop right now, but I use regular moving averages. And I just use one. I use a 13 period moving average. Why do I use a 13 period moving average? I have no idea. Actually forgot why I do, but I use a 13 period moving average. Where are you at? On my Renko charts. And this is a workable, usable crossover system. And I use like a Gann swing chart, so I when prices cross a when a Renko brick forms across that average, I wait for a 2 brick confirmation before I would enter along. Same with you know, taking profit or going short. I wait for a 2 brick confirmation past the average. Okay? But otherwise, a crossover system using Renko is, if you follow it mechanically and you have it set up correctly, you'll do pretty well. There's a lot of positives with that. The thing, this is probably the easiest trading system that I ever used and that I've ever used. And if you want something that you can, you know, without a lot of headache, this is one of them. There, I mean, I would use an oscillator of some sort. Like the composite index. Or actually, you don't even, the RSI is perfectly appropriate for this kind of for these kind of charts. Okay, it looks kind of wavy and funky, but that's okay, because all we're really looking at are the peaks and the troughs. Okay, so if if I know, I mean, these really help put out clear divergence signals. And the thing is that if you do the composite index on this, they're gonna look the same. The composite index and the RSI are gonna look pretty much the same. They might deviate a little bit, but otherwise, you know, we're not relying on volume here. We're not relying on any time principle. We're just involved in price. So, you know, we have this higher high here, and then we have a lower high in the RSI. That's enough of a, when I see this happen, that's enough of a signal for me to say, okay, I probably don't want to hang on to my long trade here. And then once I see it cross below the average, I know that I've got a good short, more than likely. Same way right here, we see that there's this regular bullish divergence going on. And so I see that there's failing to make new lows in the RSI, and then when we cross above, that is my long signal. All right, you can spot divergences very, very easily with the RSI and Renko charts, and it's a very, very noise-free way to trade. It's very, very, I mean, I don't know of a way that doesn't make it a lot. Like, for instance, right now in big, so this is a 100 brick Renko chart. Right now there is a flat support zone here. Okay, what do we see in the RSI? There is bullish divergence going on. Okay, you can look at flat as if you get rising higher lows in an oscillator and prices are flat, that is still divergence. So we have regular bullish divergence here, where we see a flat price support zone, flat lows followed by higher lows. And so that is a positive buying scenario. Okay? That is the only application of of moving averages in a crossover that I see and that I would ever want to use, because anything else is just way too, it's using candlesticks and moving averages is it's a recipe for disaster. Let's see what this doesn't work so great on point and figure because that's a different calculation, but I don't know if this is really working on line break either. Line break is a funky way to trade. But I want it like kind of no. Yeah. I think I've looked at that before, but otherwise, yeah. Renko charts for moving averages are just fine. All right. Let's take a quick look at the market here. What do we think is going to happen? What could go on? It's still above a supportive trend, two supportive trend lines on Bitcoin. I really don't see this doing anything drastic one way or the other. The only thing that I would say is that this move down it could provide a lot of momentum to get more volatility and activity in, and that's what we really need to see prices break out higher. We just need to see people step in and participate, and that's what we want to observe and have happen. So, and that is definitely what we have going on. We had a lot of nice volume step in this morning, and we can see a lot of buying tails in here. So watch this market at the end of the day, like right now. So, but otherwise, folks, this is still a hurry up and wait scenario, and I know we'll have more exciting stuff to talk about later on. But for right now, this is just kind of a meh, just kind of a blah market. So, yeah, just keep your head on your shoulders, and yeah, we'll have a lot more to talk about tomorrow, hopefully. Definitely this week. I was looking at the Aussie dollar pair, doing some long-term analysis on it, and we could compare as far as the length of time. So the Australian dollar is probably going to experience a 90-day bull move starting this week because it's been down for 273 days, which is the 270-day cycle in GAN is one of the most powerful intra-year cycles, and certainly Bitcoin is just like that, and actually Ethereum is probably a better representation just for the dates. But if we look at the date range between then and now, and we're right on the midpoint of a 192-day cycle, but we've got 288 days, which is that is part of the 270-day cycle. And when you're in a sustained down move for 3/4 of the year, it is very common, and I don't mean just the calendar year. I mean like a year cycle, as far as a year from any important swing high or low. When you've spent 3/4 of 365 days in a one direction move, whether it's bullish or bearish, you can definitely expect a 90-day move very soon. All right, a 90-day drive that will end the year in the opposite direction. All right, and that is the kind of thing that we should observe have happen around here. We're right. Today is the 50% level of the current law of vibration cycle. And just like we were talking about Friday, I was talking about the stock market, U.S. stock market, and talking about how these markets still have a ways to go down, and that's exactly what we're experiencing here. There's still more sell pressure behind this. It hasn't settled yet. I mean, we could be, we might be at the end of a 3-day. I bet we have to find support at 60, 65.85, or all the way down to 60.100. We'll see though. But anyways, I don't want to take up too much of your time. If we don't have a lot of stuff to look at, we're just seeing a market continue to consolidate, then, you know, don't want to try and force any trades or anything. So we're just going to hang out and wait. But anyways, keep your powder dry. Look at these markets closely. Set some alerts because the ranges are still extremely tight. And this evening, I will be with, well, let me pull up the time here. I'll be with on CryptoSomniac at 8 o'clock Central Standard Time. CryptoSomniac, you can just put that in YouTube and their live channel. I'll be a guest on there talking about a couple things like trading, charting, and all that stuff. But yeah. Anyways, have a good rest of your trade day. Have a good start to trade week. Hope your weekend was good, and I will talk with you all tomorrow. Bye-bye.